Hey, good morning, Rocio. All right, guys. Well, let's go ahead and get started this morning. Today's topic is going to be finance training. And tell you what, probably one of the more important things that I've made it a point throughout my career to learn. Finance training is absolutely critical, in my opinion. And the reason for that is because we've got to make sure that we're involved in our transactions. We do need to remember we're not loan officers. We're not the ones that pull credit reports. We give general advice on finance, but we don't get into real deep specifics. That's why we've got to have a good loan officer helping us. So we definitely want to make sure that we're following up, following through, keeping in touch with our LOs and seeing what all is going on. So anyway, without further ado, let me go ahead and just get this training started this morning. But again, the disclaimer, don't forget, let the loan officers do their job. They stay in their lane. We stay in our lane. Pardon me. First thing we've got, guys, as we go through here, let me go to the next slide. Working with buyers. One of the things to keep in mind is we've got pretty much 11 steps that we want to go through working with buyers. You get your license, you prospect. Why do you prospect? Well, you prospect to get an appointment. What are you going to do on the appointment? You're going to qualify. Number 4 is absolutely the most critical step in the process. Make sure that you get them qualified. Once you've got them qualified, then you go out and show, you're asking closing questions, you're handling those objections, and you've got the offer and the counter offer. You're maintaining the contract, and finally we close the transaction and we get compensated, we get paid. And when we do that, we're asking for referrals. What am I doing when I'm asking for referrals? I'm prospecting again. And again, we call this serial selling, just going down the line. But the most critical part is number 4. I tell people all the time there is crying in real estate, because if you don't do step number 4, guys, you will end up with tears. So anyway, let's go on to the next slide here. And 2 things. Primarily what we're looking at and working with clients, they are interested in finding out about the down payment. They're interested in finding out about the monthly payment. Here's where a big part of the educational process comes in. We move forward, and really there's 4 things that every buyer should know, and that would be monthly payment, down payment. We just talked about that. And then the other thing, a lot of buyers do not understand that there is closing costs and prepaids, and they get confused about that. Buyers many times will only ask us for a down payment. We need to make sure that they're aware of the fact that they're going to need more cash many times than just the down payment. They're probably going to need some closing cost and prepaids. And then I'll do another class, probably a short video on the effective cost of home ownership. What are the benefits of having a home versus renting? And I'll talk about that in a different video. First thing that we do need to talk about, payments. Well, what's going on with our payments? We need to understand that there's principal, interest, taxes, and insurance. Jokingly, I tell everybody it's a pity we have to make a payment, but principal and interest, we need to understand. Typically on a fixed rate loan, which is the majority of the loans that we're doing right now, P&I will not change. A portion of your payment goes to pay off the principal. A portion of your payment goes to the mortgage company for renting their money. That's basically what interest is renting money from a mortgage lender. Taxes, obviously, there's an escrow account. The mortgage company takes a portion of your payment, and it's a 1/12 of the estimated taxes for the year. That way the money is there at the end of the year to pay the taxes. We do need to remember, and I'll cover it in a little bit, that taxes are paid in arrears. So we're in 2018 right now. The tax payment we get at the end of the year will come back and pay the taxes for 2018 right now. And then, of course, there's homeowners insurance. This is not to be confused with mortgage insurance. This is homeowners insurance. This is what replaces roofs when we have hail damages, things of that nature, fire, major catastrophic things like that. So anyway, it's a pity we have to make a payment: principal, interest, taxes, and insurance. The other thing we look at, we do have a mortgage chart, and we'll use this just to calculate a couple of payments real quick. And basically, this chart is payment per thousand. So you can see $1,000 mortgage amount. If someone's borrowing, say, 4%, 30 years, the payment every month would be $4.77. You'll see how we use this on the following pages. Next thing we've got, and these numbers are good for El Paso, might be a little bit high for Dallas-Fort Worth. El Paso does have a little bit higher tax rate, but important factors. Taxes, we're going to take the sales price times 0.0025. Homeowners insurance, we're going to take the sales price times 0.00045. These are monthly factors. So this will give us a monthly amount because we're going to be calculating some monthly payments. If you take a look, here's an example: $150,000 sales price. You've got a 30-year term. So we're taking out a 30-year mortgage, 4.5% interest rate. So the very first thing we do is we take the 150 divided by the 1,000. That gives us 150. 507 was our factor from our mortgage rate chart. So we can figure out, even without a financial calculator, without a fancy app, P&I on a $150,000 property at a 4.5% interest rate is $760.50. Taxes, we did our formula for 150,000 times 0.0025. Taxes are going to be about $375 per month. Insurance, basic homeowners, $67.50. So just a quick analysis: PITI 1203 on this $150,000 property. Now we will get into more detail on the next couple of slides. We'll actually figure a VA transaction. We'll figure an FHA transaction. So let's take a look at that real quickly. You go down the page. VA, big benefit with VA obviously is 0 down. 30-year term, 4.5% interest rate. And in this example, 150,000, there is a funding fee. Anytime that you're taking out a mortgage, guys, figure out what are the additional fees on the mortgage. Unless you're putting 20% down, there's typically some kind of additional cost involved in taking out this loan. VA is no exception. They charge, VA charges, it's a guaranteed loan. To guarantee the loan, they charge a 2.15% fee. So what you're actually going to borrow if you're a veteran or active duty military isn't $150,000. You're able to roll in the 2.15% funding fee. So they're actually typically borrowing $153,225. Now, there are some examples where the veteran will not have to pay that fee. And what's going on there, if they've got a disability, typically they do not have to pay the funding fee. This will be on a document that they'll get from the military. It might be on their DD-214. It may be a different document. Get with your loan officers. They will know what to look for there. So anyway, going back to the example, $153,225. We rolled in the funding fee. Divide that by 1,000, 153.225. 507 is our factor, 4.5% interest, 30-year term. We got that from our chart. So P&I in this example, $776.85. Taxes are going to be the same, $375. Insurance, $67.50. So on this VA example, $1,219.35 would be an estimated payment. Okay. One thing I do want to mention about the dollar amounts I give, they're typically a little bit higher than they probably will. I'd rather be conservative and have them still excited about a payment that's a little bit lower than what I might have guesstimated for them. And of course, the loan officer will give them a much more accurate amount when they go in and do the loan application and they get the loan estimate from that loan officer. Again, I just want to make sure you guys understand how these payments are being put together so you know what's going on with the mortgages and the loan payments. Next example, let's take a look here. We looked at VA. Let's look at FHA. This gets a little bit more complicated. You're looking at FHA with a 3.5% down payment. So what do we got going on here, guys? We're going to do the same thing. 30-year, 4.5% interest rate. So I've got a sales price of $150,000. My down payment gets subtracted. That is $5,250. They're actually got a loan amount now of $144,750. Now, here's the tough part. FHA has an upfront MIP. That upfront MIP is 1.75%. So we take 1.75% of this 144,750, but when you add back in the upfront MIP, they're actually going to be paying on 147,283. So you can see basically what's going on here, guys. Half the down payment gets eaten up by this upfront MIP. That's why I have to have an adjusted loan amount. So I come up to 147,283. I divide that by 1,000. I've got the 507 from the factor chart on our previous pages. Here, our payment's going to be higher. You're looking at a P&I of $883.70. Ongoing MIP. Wait, Tony. So you had an upfront MIP. You also have an ongoing MIP or an annual MIP, it might be called. And this will vary. We calculated it here at 0.60% annually. It might be at 0.85 right now. Either way, don't worry about quoting it. We're going to let the loan officers do that. But in this example, if it was 0.60 annually, that would add $73.62 monthly to this payment. So we have P&I, ongoing MIP, taxes, insurance. You can see our payment at just under $1,400, $1,399.82. We go down the page, guys. Let's take a look. We've looked at VA. We've looked at FHA. Let's look at them together. Bottom line, in this example, our payments are about $180 different between an FHA payment and a VA payment. Now, the other thing that we need to be aware of, on FHA, this $73.62 that's paid every month never goes away, okay? Ongoing MIP on an FHA loan never goes away. I think we're all familiar with the fact that on conventional loans, once you get to an 80% loan-to-value ratio, or once you get a 20% equity position, okay, if you had private mortgage insurance, you can get an appraisal done. You can go ask the mortgage company to get rid of that private mortgage insurance. Private mortgage insurance does go away at some point in the future when your equity is bigger than that 20% on the loan, on the value of the property. So anyway, be aware of that. FHA is an awesome program for folks that don't have a lot of down payment. You might recommend to people, though, take care of your credit. When life gets better, value goes up. Maybe you have a little bit of money to put down on the principal. Go refinance conventional. FHA got some additional costs. Just be aware of what they are. VA also, their additional cost is what? The funding fee, that 2.15%. Again, if a veteran or active duty military has some kind of disability, typically that will be waived. So anyway, VA, FHA, you can see some of the differences here and what is going on there, just so you're aware of what's happening on those. Okay. Next thing, man, every buyer is different. Okay. We're going to look at what it takes to qualify for a mortgage loan. And we do have some formulas. We do have debt to income ratios. These are guidelines. Many times the mortgage companies are able to go higher than these guidelines based on what we call extenuating circumstances. And let's take a look at it piece by piece, and then I'll give you a brief summary of it. Okay, the 4 C's of qualifying, and the first one obviously is career. Cash. Do you have, what are the assets? What do you have in the bank? Credit is the other part of it, and character. Okay, career. How do you make your income? Do you have a job? Are you on Social Security income? Do you have your own business? What are you paying taxes on if you do want to qualify with that business? Credit, we get into obviously our credit scores, the amount of credit, what type of credit we have. Character, they're looking at things like education here. Folks that sometimes have more education are less likely to get foreclosed on, probably because they can get a little bit better job because of that education. And character really kind of ties in with that credit score as well. Do you do what you said you were going to do? And then another extenuating factor, sometimes the amount of cash that you have in the bank after you've closed will help you get qualified. A lot of our first-time home buyers, they're scraping every nickel together to be able to purchase the property. And if that's the case, they may have very little cash left over after the closing. That is something that sometimes will concern a lender. Now, if they've got a couple of months of payments left after they close, that may help their qualification with some of the different loan programs out there. Again, get with your loan officers. Everybody is different. Every buyer's got a different set of criteria and circumstances. Let's look at each of these individually. And the first one, look at career. There's a phrase in the mortgage industry called ability to repay. One of the big things that underwriters are looking at is, are these folks going to have the ability to repay for the next 15, 30 years? Obviously, no one can predict that for sure, but one of the things they look at is what has been previous job history. That's why they're looking at the last 3 years of income taxes, things of that nature. Okay. How long have they been in the same line of work? Are they self-employed? Okay. Commissions is another part of it. Someone might have had a really good year last year, and maybe the previous 2 years before that were good, but maybe not quite so good. The mortgage company might think, well, you know what? This last year was an anomaly. Let's not use that to qualify. Let's average out commissions over the previous 3 years, and that's what we say they will do. Self-employment, that's another tough one, guys. A lot of lenders for your regular VA, FHA, some of the standard loan products, they are looking at page 1 of income tax return. And there's a line on there called adjusted gross income. Someone may be living a $200,000 a year lifestyle. They're taking a bunch of deductions, so they show just a $50,000 a year income. The $50,000 is what the mortgage companies will use to qualify on a standard loan product. We will talk at the end of the training session about a program that might help them where they look at their bank statements and their income. And so there's different ways to skin the cat. Right now we're talking about standard financing. Child support is another one. If it's being received, it needs to be proven. If it's being paid, it will be deducted. Income properties. This is another one. If you've got some rental properties, there's some different guidelines that need to be looked at there. Obviously, you don't get to keep all of your rental income. You've got vacancies, you've got credit losses, you've got taxes, you've got insurance you've got to pay. So typically, they may use about 75% of the income to help you get qualified. Continuity of career is another one. The type of career you're in might be another one. There are some careers that are very, very popular, high demand, nursing, things of that nature. Again, everybody's going to be just a little bit different. So that would be career. Next one we've got cash. How much cash do you actually have available right now? The amount of your down payment many times will determine the type of financing. If you're a veteran, obviously you've got that benefit of zero down. USDA might be another choice if the property's in the right area. We'll talk about that a little bit later, but that will also be zero down financing. There are some income limits there as well. The other thing you've got, if you've got a minimal amount of cash down, you're not a veteran, property's not in a USDA area, FHA may be the way to go, okay? Gift funds, don't forget about that. If some close family members want to give money, we could get a gift letter. Obviously, the income is going to have to be sourced. So we are going to need mom and pop's bank statements to prove that the money is not what the government calls ill-gotten gain. All of this changed after 9/11. So anyway, man, everything is going to have to be sourced. Mattress money needs to be in the bank for 90 days. It must be seasoned with most of your standard loan programs. Are some exceptions. We'll look at that again near the end of this particular training session. Next thing we look at, guys, let's take a look at credit. What are we worried about? Well, and not so much we, but what is the mortgage company worried about? What's the underwriter worried about? Lack of credit, slow pays, bankruptcies, judgments. Now, let me just mention this on bankruptcies and judgments. If they have passed the 7-year time frame, it's been a while since the bankruptcy. Don't lock in that 7-year, guys. It might be less. Check with your loan officers. There are different types of bankruptcies. A lot of buyers that got in trouble, maybe even lost their properties, had financial heartache back when the market crashed in 08 and 09. It may be time for them to take a look again. They may be qualified to buy a property. They have such a bad taste in their mouth, though, and they were so embarrassed about what happened, they may think that they can't ever buy again. But that may not be the case. We call them bounce back buyers. So keep that in mind. The other thing they're looking at, are you overusing your credit? Do you have, one credit card with a $10,000 limit and you owe $9,900 on it? That would be an overuse of credit. From what I've learned, talking to different loan officers, guys, mortgage companies like to see available credit, the total, and you not using more than about 30% of it. So anyway, again, check with your loan officers. Also, check with some of your credit repair folks. They can help you with that issue. Obviously, credit is a big, big concern and something that needs to be looked at. Next thing we've got, areas of strength, responsible use, credit established over a period of time, and a good track record. And basically, they're going to be looking at the FICO score. FICO stands for Fair Isaac Company. We'll look at that here in just a bit. And very next slide. Be aware, highly recommend this. Everybody can go pull a credit report from annualcreditreport.com. So go snag that every year, check your credit, see where you're at, make sure there's no mistakes on it. High percentage of credit reports do have errors and mistakes on them. And so take a look at those websites. And then you've got the chart there. 35% of your score is based upon payment history. The amounts that are owed is about 30%. Length of credit history is 15%. New credit, 10%. Types of credit, 10%. So anyway, all of this ties in together, guys, to give you a FICO score. And we'll look at that in a couple of slides, give you some options there. But here is something that I've picked up from a couple of loan officers out there in the field. And again, it's October 2018. This might be different in the future. But right now, FHA is looking at a minimum of a 580. VA, 600. Conventional, you're looking at 620s. USDA, a 640. Bond loans, some of the down payment assistance programs that are out there, guys, they're probably looking at a 620. Everybody's always asking, well, what do you think I need to be at? Man, if you can be 620 and above, you've got a shot at the majority of the credit here. You can see that on the screen. So keep that in mind on FICO scores. Take a look. You've got character, areas of strength, education, job growth, promotions, community involvement might be something they look at. Concern, have you been in jail? Is there time missing from your employment record because you were incarcerated? Now, let's take a look at qualifying. What do we got going on here? Well, here is somebody that's making, say, $5,000 a month. And this would be these ratios here, this 29-41. Some people will use 31-43. I would tell you this just to give you an idea of where you're at. But 29% of $5,000 is $1,450. So on this side of the equation, on the front end, as we call it, you're qualifying, you would qualify if you've got this kind of income, monthly income, gross income, before Uncle Sam gets a hold of you, before you pay any taxes, this person would be qualified for a PITI, full payment of $1,450 a month. Now, the back end, the back ratio, 41% of 5,000 is 2,050. Let's say that they've got debts of $850 a month. Now, when I say debts of $850 a month, we're looking at car payments, credit cards, Ashley Furniture, okay, whoever it might be. These are items that show up on your credit report. We're not talking about things like life insurance, health insurance. Those can all be canceled. They don't show up on your credit report. But in this example, you take the $2,050, you subtract the car payment, the minimum Visa payment, the Discover card, whatever it might be. In this example, we're saying it's $850. So on this side of the equation, they're qualified for $1,200. Be aware, it is always the lower of the two. So they're not going to qualify for $1,450 because of the debts. They could go get a PITI of $1,200 a month. And again, there's some different things that might change here, things that might not be included. Typically, if there's a debt that can be paid off in less than 10 months, okay? Let's say you've got a car payment. You only got 3 more payments left. That payment would not be included in the $850 here. So keep that in mind. And again, your loan officers will be able to pull the credit report. They'll see what's on the installment on there as far as installment debt. And of course, you're going to be interviewing the borrower when they do their loan application. This is for us to know, to see what's going on there. Next step. Here's someone making $4,000 a month, okay? This example, 29%, they're at 1160, 41%, 1640. If they have about 800 in payments, you can see how that really brought them down to about 840 a month. So again, just some of the different qualifying ratios, and you can see why folks shouldn't be getting in debt. It affects their ability to purchase properties. So anyway, there you have it on qualifying ratios. Also, guys, be aware this 41% is not written in stone anywhere. You may get up as high. I've seen some people get up as high as 53, 56%. I've heard from different loan officers. Obviously, they're going to have a really good credit score. They've probably got a little bit of cash left in the bank, but again, stick with this ratio when you're just giving general ballpark numbers. But get with your loan officers; they'll be able to figure it out, give you a more accurate number there. Okay, and again, we talked about this. What's included in installment debt? Anything that's on the credit report, the car payments, the credit cards, the bank loans, furniture loans, things of that nature. One other rule of thumb, and this is just very basic, people can typically buy 2 to 2.5 times whatever they're making in a year. So someone that's making about $50,000 a year, just over $4,000 a month, they probably qualify for about $100,000 property, or they might qualify for 125. 2 to 2.5%. Okay, so that'll give you an idea of what folks can afford. Again, just a generalization. This will vary because of debt ratios, so keep that in mind. Let's talk a little bit about prorations. This is something that we need to be aware of for closings. Okay, we talked about taxes a little while ago. Every month we're paying into our escrow account. So at the end of the year, the money is there to pay taxes in arrears. We need to be aware of what's going on when we close during the year. And we'll look at that right now. Interest, this is going to be different from our rent. We're all familiar with rent being paid in advance. Today's October 1st. You pay the rent, you get to stay the month of October. Those of us that own property and we've got a loan on that property, the payment we're making today on October 1st is actually covering interest for September. So interest is paid in arrears. And our homeowner's insurance obviously is paid in advance. So when we go to closing, they charge you a full year of insurance. So you close today, October 1st, your insurance is paid up till the end of September next year. And then the money's got to be there to pay your insurance for another year. Again, that's going into your escrow account. So be aware of what's going on there. Now, let's keep going. And here is a tax proration. Here is your closing date, just past the middle part of the year. And basically, you pay for it when you own it. They pay for it when they own it. That's the definition of prorations. So if you're the seller, you're going to be responsible for taxes from the beginning of the year through the closing date. Now, your buyer is going to be stuck with the house at the end of the year. They're going to have to pay taxes for the whole year. So to make it fair, what do they do at the title company and what do they do at closing? They debit the seller, they credit the buyer this amount right here in yellow. That way, seller pays for it when they own it, buyer pays for it when they own it. Again, that's your proration, and this will be included. This is what we call our prepaids, and this will be, again, this will come out of the seller's cost. Now, one other thought to keep in mind. Seller made a payment January 1st, February, March, April, May, maybe even June. Maybe this is in July here. Well, he's put money in his escrow account, hasn't he? They do charge him this amount here. But about 3 or 4 weeks after he pays off his mortgage, they're going to send him whatever money is in his escrow account because he's been putting money in there, okay? So keep that in mind as well. Got any questions on this? Holler at me. I'll break it down some more for you. But that's basically the tax proration, and this is what happens at the closing table. Now, the next slide, a little bit different, but let's take a look here. And let's say that you're closing June 15th. And here's where buyers and loan officers, agents, we're all guilty of this. Everybody wants to close right at the end of the month, so they only have to pay a few days of prepaid interest. The problem is many times it's jam-packed at the mortgage company, title company at the end of the month. Now, pick closing dates in the middle of the month. If you do close in the middle of the month, your buyer is going to have to pay interest from the closing date till July 1st. But here's the cool part. They will not have a house payment till August 1st. Okay, so kind of a different thought. Now, what's it going to cost in prepaid interest? Well, let me give you one example. Let's say we've got a $150,000 loan, 4%. I know that's lower than market right now, but this is the example I've got. That's $6,000 a year. You divide that by 12, that's only $500 a month. Let me ask you the question. Where can you live for $500 a month? If it's only half the month they're paying for, they're paying $250 to live in this property and interest for this 2-week time frame. Yeah, they're paying utilities, things of that nature, but they're not going to have a house payment for 45 days. Why? Because they close middle of the month, they prepay this time frame. Now, when they make their August 1 payment, they're paying this off right here. Okay, so anyway, this is where you're at. This is what's going on right here. So what's the moral to the story here? Close in the middle of the month. Don't wait till the very end of the month when things are going crazy. Okay, and again, this is interest. Now, I would just tell you this story. Most people close into the month. They're moving out of one place, moving into another. They think they can get it all done in one weekend. It doesn't happen. Close with time, move into the new place, go back, clean out the old apartment, the old house. Now you have a much better shot of getting your deposit back rather than leaving it a mess and not getting your deposit back. And I would be willing to bet the deposit's more than $500 a month. But anyway, whatever that's worth, take a look at that. And that's why I'm a big fan of not closing at the very end of the month. Close in the middle of the month. Give people time to move out, clean up the place, get their deposit back if they are in fact renting a place and they're trying to get that deposit. Here we go. Let's keep going. Closing cost. What are closing costs? Well, prepaids are about 1.5%, maybe 2%, probably closer to 1.5%. What are prepaids? At the closing table, your buyer is going to have to pay 14 months of insurance. Remember, they paid a year in advance. 2 months of insurance is going to go into their escrow account to get that escrow account started. The other thing they'll do, guys, depending upon when we're closing, near the end of the year, it may be a little bit more, but they're also starting the escrow account with a month to maybe 3 months of taxes, because they know they're not making a payment for a little bit, and they want to make sure they start putting money in there immediately for taxes, which have to be paid at the end of the year. And then closing costs, those have come down a little bit with legislation and time, but closing costs on the loan are typically somewhere in the neighborhood of about 2%. I'm not including any discount points here. Rates are sufficiently low enough, I think, that probably people aren't paying a whole lot of points. But anyway, keep that in mind. You probably, let's say you're an FHA buyer, you're going to need 3.5% for down payment. Be ready for another 3.5% in closing cost and prepaids. You need a total of 7%. Depending on the market you're in, maybe you can get a seller to pay the closing cost, and all you come in with is the down payment. But anyway, keep that in mind. It's something buyers will always ask you, what's the down payment? What they're really asking you is, what is the total amount of cash I need for closing? We need to educate them on the fact that there's not just closing cost, there's also there's not just the down payment, there's also prepaids and closing costs. So keep that in mind as you're out negotiating transactions for your buyers. And while we're talking about it, don't forget your sellers. They've got their own closing costs. They're going to be paying a commission, plus they probably have about 3% in closing costs. Looking at title policies, release of liens, things of that nature. So anyway, be aware that that there's some cost involved there for the seller as well. So anyway, let's take a look. Give you a written example here. Let's say $150,000 property. Well, 1.5% would be $2,250. If we get into it, 2% would be $3,000. 14 months of insurance, 3 months of taxes. We do some calculations, guys. Bottom line is we end up with total prepaids of $2,065, just under the 1.5%. Remember, I told you my numbers would be conservative. This number is probably a little bit lower than what I quoted, folks. Generalization. So I think we're good to go there. Next thing we've got, just to give you an idea, just a discussion point. I got online again today to see if they had updated this, but they had not. This is from Freddie Mac. This is an interest rate history. Rates are going up just a little bit right now. We're getting up near 5%. Well, basically, we're getting up to where interest rates were maybe, 9 years ago in 2009. But if you look at the interest rates before that, guys, I mean, go back to 1983, interest rate of 13%. 84, they're showing 13.88%. Okay, we're fortunate this didn't go back into the late 70s. Some of our interest rates actually went up higher than that. So anyway, this will give you an idea when someone starts squawking about interest rates. This is a good chart to show them saying, man, you ain't got nothing to complain about. Rates have been good. Rates are still good right now. And so just some facts to show people out there. By the way, I will be putting this presentation on our Facebook page so you guys can review it later. Next thing we've got, and you can print this out and use it, but we break down, especially in El Paso, because we do so many new home sales, and many of the builders there will pay a buyer's closing cost. If you've got, for instance, the first column, a VA buyer, 0 down, they do need their prepaids. If the builder pays their closing cost, you might still need a little bit of money for prepaids. Many times we can get enough contribution that the builder will pay their closing cost and their prepaids, and they get in for 0 down. FHA, we do see that quite a bit. 5% down, 10, 20% down. You can see maybe all they need is their down payment with some of the builders out there. If they need to pay their closing cost, we would need the down payment plus whatever closing costs might be. So anyway, just a little bit of a financing tip here, a sheet for you to look at. Resell homes, if we're not getting any help from an owner, okay, this will give you an idea. VA, they may still need 4%. They may need closing costs. They may need prepaids, okay? So again, these numbers will vary, just looking at where we're at there. And these numbers are probably a little bit high right now. But resale homes, this might be true especially in the Dallas-Fort Worth market, where sellers are still probably not helping a whole lot with closing costs. So keep this in mind. Next thing. What is our maximum FHA loan amount right now? In El Paso, it's $294,515. This kind of blows my mind that we'll let someone buy a $300,000 home with only a 3.5% down payment, and they can get a mortgage of $294,515. The maximum conforming loan limits, guys, on conventional and VA, $453,000. So if someone's buying a very expensive property, they're trying to get a conventional loan over a $453,000 amount, then you're looking at what we would call a non-conforming loan or a jumbo loan. So this will give you an idea of some of the dollar amounts on some of the loans out there. Next thing you've got, don't forget about USDA loans. It's got to be in the right area. Typically, it's in a city less than 20,000 in population. The cool part is 0 down payment. What does it cost to use the program? It's a 1% guarantee fee. There are some income limits that apply, okay? So if you take a look, and I got this off the USDA website today, in El Paso, and this is family of 1, family of 2, family of 3, family of 4, 5, 6, up to 7 in the family. So basically, guys, family of 1, as long as they don't make more than $82,700 a year, they could go for USDA. If it looks like 1, 2, 3, you get into 4 in the family. To 7, they cannot make more than $109,150. They do take the incomes of everybody in the household to come up with these numbers. So if Junior's working at Whataburger, that'll get thrown in there as well. Dallas, a little bit higher. They're starting at $88,750. They'll go a little bit higher as well on the high end. They'll go up as high as $117,150. So again, just be aware of this. Get with your loan officers. They can plug in an address on the USDA website, and they can tell you if the address will actually qualify and if it's in the right area for USDA. But just for your knowledge, some of the things that are going on here with USDA. Now, the other topic that we talked about, and we had this presented to us at sales meeting on Monday, the ITIN loans. Buyers who don't have a social security number, ITIN stands for Individual Tax ID Number. They do have an individual tax ID number. They are paying taxes. So it's a 15 or 30-year note. Looking at a 620 credit score, but no score is also allowed. They will need to do a verification to get that going. 75 to 85% loan to value options. So what are you looking at here? They're looking for 25%, 15% down. The minimum loan amount's 80 grand. They will make a maximum loan up to 280. Cash on hand, mattress money is okay. You can purchase, you can refinance with an ITIN loans, and you can get a seller to help you up to 6% on your contribution. So this is similar, the contribution is anyway, to FHA. VA, typically, you can only get a 4% contribution from a seller, enough to pay their closing cost and prepaids. But anyway, keep this loan in mind, guys. You may have some borrowers out there that qualify. Bottom line, 15 to 25% down. That's probably going to be variable depending on how strong your buyer is, how much cash they've got on hand. All of this is taken into account now, okay? So keep that in mind, ITIN loans. The next one, we talked earlier about that adjusted gross income on the front page. Well, here, this might be for that business owner who's living on $200,000 a year, taking all the deductions and only showing $50,000 a year in income as an example. This is for self-employed borrowers, okay? They have to have been in business for at least 2 years. They want bank statements for 12 months or 24 months of business statements, so either of the two, and you're looking at a 10% down. 90% loan to value ratio is 10% down. Look at the credit score. Going to have to be someone solid at a 660. This is not going to be for a little house. It's going to be a minimum $150,000 loan. You can have some mattress money. This will not allow refinance. It is purchase option only. There are some seller contributions allowed if you want to be, if you're able to get some help with closing costs. This will open you up a little bit to business owners that maybe were not able to get a loan a year or two ago. This is what they are calling, guys, a non-qualified mortgage. This is not a conforming loan. This is going to be a portfolio loan. This is one where the investor or the bank is making the loan and they are keeping the loan in their own portfolio. So keep this one in mind. Check with some of your loan officers on this particular loan program. And then finally, guys, That's all I've got on basic financing today. Any questions out there, Mr. Rosillo? No questions at this point. Okay, good deal. Well, let me go ahead and get going up here. One thing I do want to mention, guys, is please do not forget we're not loan officers. This is for our knowledge. We can talk generalities out there with the general public, but let's make sure we get them hooked up with some good loan officers. Touch base with me if you need sources for any of these types of financing. I will do some more finance videos, probably do one on net sheets so we can show you how to figure out a seller net. Do another video probably on down payment assistance programs. That's a whole different category all by itself. This particular one, we just call it a finance training overview class, just a brief overview of some of the major programs out there. Anyway,